overall, looking at what the picture was in the morning. We've got advance decline ratio, which is what, 3:1 in favor of advances. Too early, although, to make any conclusions which way this will head. I mean, yesterday, for example, through the bulk of the day, the gap between gainers and losers kept closing, and by the end, it had flipped. More losers than gainers. Just a few other names. I mean, you know, if you want to look at stuff with volumes at this stage, it's Zomato, as we highlighted already. IRFC, one of these railway stocks, which is up 3% or so. Reliance is starting just a touch higher. But again, I mean, this is a very, very flat kind of starts is what we have. On the downside, if I can just take a look at a few names, what do we have? Infosys is starting about 0.6% lower. RVNL saw some pullback yesterday, and I think that continues today. Gland Pharma is down 2.5%. Paytm starts about 0.6% lower. And you've got Jubilant Food, which is down about 1% or so. So it's a very quiet start. On the index, though, this is looking pretty solid with a 50-odd point up move. Again, I mean, you know, just to take a look at where is this push coming through on the Nifty. If I can just quickly look at this. ICICI Bank and the three banking names, ICICI Bank, HDFC and HDFC Bank, is where about 25 of this sort of 50-60 point move is coming from. But, you know, the fact is very little on the Nifty is down. Bulk of it is higher, 0.5%, 0.75%, 1%. So, I mean, there is kind of a broad sort of green out there on the screen at this point. Our market master of the day is Saurabh Mukherjea, founder at Marcellus Investment Managers. Saurabh, great to have you with us here on the program. Thanks very much, as always. Prashant this side. New highs, Saurabh, and looking ahead, I mean, when you get to new highs, you kind of call it uncharted waters now, right? So anything is possible in that sense. What is your sense from here? And this also kind of coincides with the end of the year. You're looking into 2023. What's your sense? How are things looking?
I wouldn't exactly call it uncharted waters, Prashant. I think this is fairly familiar territory for India. This feels a lot like where we were before COVID. The economy has normalized by and large. Credit offtake is building up towards mid-teens. In fact, it's going towards high teens. Foreign investor interest is back. You would have seen it in the last month or so. I can see it from the foreign investors going through Marcellus's offices. And whilst all of that is happening, China seems to continue shooting itself in the foot. So the combination of a domestic recovery, which is fairly broad-based, evident across lots of companies now, and the combination of China doing whatever it is doing on COVID means that foreign money and domestic recovery will carry on underpinning the stock market right through 2023.
Saurabh, morning. What's the investor feedback now that you get after the markets have hit record high levels? I remember a month back, when you had come back from the US, you had met a lot of foreign investors, and they were very gung-ho about India's potential in the manufacturing space. And they were citing examples of Apple. That is something you'd quoted, on record. But, in the last 1 month, there appears to be some signs of easing on China. So perhaps China is going to get back on track on the supply chain. Just tell us, what has been the feedback on what investors are saying in the last 1 month within this kind of a print on, our markets at record high levels?
So I think that the further development in the last month has been, I think, an even further hardening in the American stance. By American, I mean both the American government stance on China and the American investors' stance on China. I think that the stance has hardened. It is pretty clear that America wants to freeze China out of the whole digital ecosystem, whether it is semiconductors, whether it is artificial intelligence. And as a result, over the past month, we've traveled a fair bit with foreign investors around India. They're very keen to see, or foreign investors are very keen to see just how much of the API industry, remember China's API industry is 9 times India's size, just how much of that can India grab? In fact, when I visit places like Baroda, Surat, Vapi with foreign investors, you can actually see Western pharma companies, Western chemical majors scouting for Indian partners, scouting for FDI spots, because it's just becoming increasingly unviable to source API from China. And it's also increasingly unviable to make API in Europe. Spain and Italy do make some API, but energy costs are 10x that of India. So I think that's the first area. Foreign investors actually traveling around the country, both looking for investments to make and looking for Indian partners on the API piece. The second point on semiconductors, the mobile phone ecosystem, just iPhone itself, if India gets 25% of iPhone 14, that itself is a $40-50 billion industry. the broader smartphone industry is another $200 billion. That itself is attracting a lot of interest. That action is around Chennai and Hosur. So that's the second spot of foreign investor interest in terms of they're traveling to actually see sites where, say, Foxconn has set up in India, or the Taiwanese company Visitron has set up in India. And the third piece is increasingly medical devices. This is a $650 billion industry. It's thrice the size of the smartphone industry, and very similar problems to actually what's happening in the iPhone factory in China. The West needs medical devices from China, but China can't supply them at any steady rate, and therefore that's the third area that investors are looking at. So plenty happening, lots of foreign investor traffic now into the country, both to set up factories, look for partners, and find investments through people like us.
Hi, Saurabh. Morning. Good to speak to you as always. Saurabh, on the third point, medical devices here in India from the listed space, do you all have some exposure?
Yeah. No, so we don't, and we are looking for investments. So if I sort of listed in order of ease of investing, the pharma API space is obvious, right? So we can do Divi's Lab, which we have in our large cap portfolio. In mid-cap portfolio, we have GMM Pfaudler. In our small-cap portfolio, we have Poshak, and we're looking for more investments. I think we will find more investments in that entire API and pharma intermediates chain. The second spot is the entire smartphone ecosystem. We are in fairly advanced stages of diligencing a company down in South India, which could have a play around smartphones. But I do have to confess that there aren't that many listed plays around this. Hopefully there'll be some IPOs around the smartphone ecosystem. And thirdly, in medical devices, there isn't any large Indian company. We have a small invest in our Little Champs portfolio. We have Tarsans, which is the leading manufacturer of lab consumables. So these are things like pipettes, carboys. But we don't really have too many Indian companies like, say, Boston Scientific or an Abbott in medical devices, and I think that's an area where we'll have to do far more work. I don't think there's a large medical devices listed play in the country currently. But if you add up these three plays, you're comfortably looking at $300-400 billion of economic activity per annum over the next decade or so. So worth doing a lot of running around to find more investments here. Just a disclaimer, all of these investments, our clients are invested, I am invested, my parents are invested.
Tell us a little bit more about the company that you're doing due diligence, which could be a play on the smartphone market in South India. Not the name, but...
I think give us a little bit more time. I think, So look, I mean, just to sort of step back and look at the big picture here, something like, say, take iPhone 14, it has 1,300 or 1,400 components going into it, right? Obviously, the highest end of the components, specifically the silicon, the semiconductor, is going to carry on coming from Taiwan. I don't think we're going to, in the near future, make the sort of very high-tech silicon which goes into iPhone 14. But where India can build a viable ecosystem is, say, the Gorilla Glass, which is on top of the smartphone, the optical lens which goes into it, the cover of the phone. Those sorts of things are being made in the country, and we're looking into a couple of companies who make those components. Our reckoning is this is looking like becoming the whole smartphone ecosystem looks likely to become as big as the auto industry a decade hence, and that's why finding well-run, clean companies who do a good job of making components for the smartphone ecosystem could be very lucrative for us.
All right, Saurabh, what about rural India? One spot of bother is urban India is doing well, but rural India is in a bit of a spot of bother. I think in the past you've been positive on stocks like V-Mart. What's your sense on rural India and a couple of these themes that you're looking to play?
So I think it's a fair point to make. I think anything around affluence, middle class consumption is obviously booming in our country. The formal job creation scene is hotter than I've ever seen it. And therefore anything which is class is doing well, anything which is mass is a little bit of a struggle. So let's take V-Mart specifically, right? Although revenues are up some 50-60%, that's because they acquired last year. There was a smart acquisition last year of Unlimited. I think they bought Unlimited, which was an apparel chain down in South India, from the Arvind Group. So smart acquisition, but if you sort of look through that acquisition, sales per square feet for V-Mart would be 10% lower than what it was prior to COVID. And I think that just underscores the absolute hammering the poor have received over the last 3 years or so. And whilst VMart management is trying to address this issue of lower sales per square feet, they've cut prices of their products. Cotton prices have come off, thankfully, in the last couple of months, and hence VMart has cut the prices of its apparel. I think it's going to be a long, hard slog to recovery for anything which is a mass play. We're seeing similar dynamic in one of our other investments, Amritanjan, which is again in the Little Champs portfolio, right? Market-leading franchise in pain relief products and balms, and again sales are down 10-20%. So I think the mass play is a challenge. Hopefully a decent harvest through the winter. Hopefully some government spending going into the 2 years of the election season, the active election season, where the North Indian states and the country goes to polls. Hopefully that will give a little bit of an uplift. But I do have to confess, I haven't seen rural India this beaten up for a long time.
Absolutely. Class versus mass, I mean, I think that's a good way to kind of put it, and broad categorization. Saurabh, this is not exactly China plus one, but this is indigenization, which is defense. Have you given the sector a look, or I mean, and what keeps you away?
I mean, look, it's a big opportunity, clearly, right? We are importing every year $70 billion worth of kit. So if we could indigenize even half of that, that's a $30 billion sector. Nothing to sneeze at, significant sector. The challenge, Prashant, is finding companies which actually do a clean job, a competent job. So clean, it's a sector where you can understand anything which involves procurement from the government naturally gets messy. And the second challenge is working capital, right? You end up taking forever to get paid. So you make all this clever kit, but your return on capital is 10 or 11%. And that means people like us don't really get very excited. So there are clever suppliers of defense kit in the countries. Some are listed, but there very few companies are able to show you return on capital above 15%. And that's keeping us away from the sector. We'll carry on looking. We're carrying on doing video calls with some of these players in southern India, but I haven't yet met a defense supplier who can actually show me that they can actually make a decent ROC and thereby generate cash. And if you can't generate cash, it's no point coming to work.
Just one final question, Saurabh. Some of your funds are underperforming the broader markets, right, over the last couple of months, over the last 1 year. Your thoughts on that, and would you like to make some corrections to the strategy or changes? And why do you think? Give us the reason why.
Look,
you think
I've been doing this for so we've been doing this for the best part of 20 years. The core team has been working together now for 18 years. So we've seen these cycles repeatedly where you will have, say, in a 10-year cycle, you'll have a couple of years where public sector stocks will do well, metals and mining will do well, anything around power and infrastructure will do well. And we've had that rally over the last 12 months and specifically over the last 6 months or so. And that is but natural, right? If the Federal Reserve pushes up the risk-free rate of interest for the world, the Federal Reserve pushes it up by 3.5-4%. Investors like us who are investing in cash-generative companies, naturally, the valuation of those cash-generative companies comes off. If the discount rate goes up, the valuation of cash-generative companies comes off. And people like us have learned to take that in our stride. If we suddenly switch from doing what we are doing, which is buy clean, well-run cash machines, to buying public sector enterprises and metals and mining companies, that doesn't make sense because the public sector companies and the metals and mining companies, they don't really have a value-generating engine. They are plays on speculation. They are plays on, say, for a metal company, they're a play on the LME metal price. It's not fundamental investing. It's a speculative play, and that's not our forte. So we carry on doing what we have done. I've seen these cycles. This is, I think, my third time of seeing a cycle where public sector and metal mining and power infrastructure becomes popular. And in such cycles, we tend to underperform. But having seen it so many times, we honestly don't lose that much sleep. We understand the underperformance. We obviously don't want to underperform. But then again, you can't really run a strategy and say 10 out of 10 years, I will outperform. The skill of an investor is in understanding where value lies. So for example, the fact that we doubled down on Dr. Lal through the summer will hold us in good stead. The fact that we are doubling down on Divi's Lab as we speak, courtesy the API point that we discussed 5 minutes ago, that will hold us in good stead. That, to my mind, is investing. You find great companies. As soon as they come off, you double down the position. and then in due course, the market rewards you.
All right, Saurabh, it's a pleasure. Thank you very much for joining us and running us through not just what you're doing, but I mean your investing philosophy as well. Thanks indeed.